Oh, good day, guys. So sorry about the network issues we have the other time. So that was too much of our time. I really had to wait for the network to come back. So now, if you actually open to the book I actually sent to you, which you're actually going to be following, you understand? We have the chapter that does talks about the basics, the market structure, liquidity, order blocks, daily range price action, powerful setups, and me us putting everything together. So without wasting much of our time now, we actually want to talk about the basics. You understand? Now, the way I'm actually explaining, you can try to just go to the book and be checking. You understand? Now, the expansion and retracement. Expansion occurs when there's an impulsive movement towards a direction, while retracement is the correction movement after an impulsive movement. Now, what we mean by impulsive and expansion, I'll actually explain about that. So now, if you check the book, they talk about uptrend, downtrend, expansion and retracement and stuff like that. So let's talk about that. Understand? So now, basically, when we're actually talking about expansion, okay, so let me first talk about the price delivery. You understand? When we're actually looking at the market, you understand, it works with the price delivery. That is, before the market starts to move, it starts with a consolidation or accumulation, then followed by manipulation, then followed by expansion or distribution. Expansion is also known as distribution. Understand? Accumulation is also known as consolidation. Then manipulation, you can call your manipulation turtle soup, buy stop liquidity or sell stop liquidity. You understand? Manipulation. Then after the manipulation, then you have the expansion or what I call the expansion, yeah. Then we have the reversal. So we have the retracement or reversal, either of the two. Depends on the zones, you understand? So for instance, now, without wasting much of our time, like I was saying, let me look for a price delivery here. Okay, looking at this gold, judging with the higher time frame, you understand? The price was also actually consolidating, you understand? Then the next thing was boom, a first breakout, you understand? It's called manipulation. You know, okay, fine. Let's go back to the retail trading schematics, you understand? So as a retail schematics, when you draw a box, you understand, it will tell you that the price will continue to oscillate inside that box. And once it breaks out either bearishly or bullishly, you understand that probably it's the breakout. That means that the price of the market wants to continue in that particular direction in which it broke the market structure. Then it will come back and retest, you understand? These are the trading strategy for 2000s. You understand? The market makers already know this, and if they don't actually work alongside with this, there's no way they're actually going to be having money. You understand? Because basically, trading was actually defined, or let me say, built for the market makers to make money, and we are just like the grasses, because an analyst says that wealth to elephant are fighting, the grass suffers it. You understand? So now, going straight to what we have here, like I said, the price delivery, we always have the accumulation, then the manipulation, and after the manipulation, we have distribution or expansion, then after the expansion, we have the retracement. And after the retracement, we have what we have the reversal. So without wasting much of our time, like I was saying, you can see the accumulation here in which the price was actually ranging in this rectangle. Then boom, suddenly it came here and was thinking that probably it wants to break out, but no, it actually came up. So we can call this buy stop liquidity. Do you know why they call it buy stop liquidity? Because now you as a retail trader, after the break, you'd have actually put your pending order of buy stop here that okay, the market should pick the price for you around this place that will continue to price, and you might want to take your TP here. That is my retest. No, they took all your orders, and those that and where you put your stop loss, they took everything. Just and came back to test to shake your emotion again. That probably maybe took everything, then immediately see what happened. Expansion. You understand? Accumulation, consolidation, expansion, retracement, expansion, retracement, impulsive move, expansion. Then when it got to this zone, we got a reversal. You understand? So now, when you're actually talking about this things as well, so now let's talk about I've actually talked about the price delivery now. I hope all of you get it. Let me go again. The price delivery has to start with consolidation, accumulation. When the price wants to move, it starts consolidating. You understand? Sometimes when you see a doji, you switch to a lower time frame in that doji, you see it's actually accumulating. You understand? So after accumulation, the price expand. After expand, there will be a retracement. After retracement, there will be an expand. After expand, there will be a retracement. Then there will be what at the end of the day will now be a reversal. So now the validation of this actually now depends on the uptrend, downtrend. You understand when you actually want to meet. Maybe after something like buy side liquidity was taken. You understand? They definitely the validation. You have the validation of you have to have a validation of an uptrend for that period of time. And what are the validation of the uptrend? You understand? That is we have the higher high, the higher low. You understand? For instance, now this is the higher high. This is the higher high. This is the higher low. We have another higher high, higher low, in which it says that the higher high, the higher high will always be higher than the previous higher high. That's the variation of what, and the higher low will always be higher than the previous higher low. This is the previous higher low. The higher low model, so that's the validation. Same thing applicable to that of downtrend. You understand? This will be the reverse will be the case. For instance, this is a downtrend now. So we have this to be our lower high. This will be our lower low, lower high, lower low, lower high, lower low. Can you see that? As long as them tends to draw distance. Or let me make it like this with so now see the validation now. This is our lower high, our lower low, lower high, lower low. That is the lower low will always be lower than the previous lower high. This lower high will always be lower than this previous lower high. That's validation for what? Validation for downtrend. Why validation for? Okay, let me put it like this. One. Yeah. So that will be the validation lower low. Same thing applicable to lower low. Why is this needing like this? Lower low. Understand? This will be lower low. So those are the validation. So under lower low here. Under lower low here. Understand? So these are the validation. You understand? This will be lower high. What I mean by this is that the lower high must always be lower. Understand? That's the validation that okay, fine. The trend is still trending. You understand? It is immediately the lower low is a little bit is higher than the previous. What was supposed to be the lower high is a little bit higher than the previous lower high. Definitely, there tends to be a change in what? A change in reversal. Sorry, a change in how I say it, a change in direction that is a reversal wants to occur. You understand? And it shows that the validation is no more, the validation for the downtrend is no more valid. Then we can call those ones SMA swing failure. No, don't worry. You don't need to more. The more we actually do this thing, today's class is more or less like explanations. You understand the basics. When we tends to like start analyze together now, you can actually and with what actually I'm saying, if you go back to the book, you don't have any problem. Understand? It's self-explanatory in the book, but just to point out some little places you can actually be making some mistake. That's why I'm actually doing this video. Understand? Okay, now so I was saying the other time that the validation means when that kind of validation happens, it means that there wants to be a change in. So we've talked about the price deliveries, you understand? So now I will say it again. Once the market is accumulating or consolidating, wait for a manipulation. You understand? When the manipulation happens bearishly, like this, it tells you that the market wants to move in the opposite direction, which is bluishly. You understand? And the markets broke out, and the manipulation happened bluishly. It means that the market wants to go back in bearishly for a long time. So, for instance, now we'll talk about this law in when we're talking about market structure, talking about supply and demand. So now, for instance, now this is good. In the weekly time frame, we saw that this actually happened. So definitely, what the market is actually going to do now is it's coming back to mitigate the other block in which the bank level left around this place before it's actually going to break very shape. The other to tell you gold is an asset, it's always buy. You understand? It will always appreciate. You understand? So now I will just tell you that when the market comes around this place, it will be a very good time for us to buy. But for now, we have to sell. Well, why is the market not selling? That's because the market makers are saying that, okay, fine, everybody is actually looking and saying this, that good wants to sell, and they cannot make their money. They should just sell the market like that. They have to shake a lot of people away. They have to liquidate people so that they can acquire their money. And that's why the system was built. We don't want to be found in that. That's why we want to learn more. That's why we are following, we are making the opportunities with the market makers. We are never going to create opportunity in the market. We follow and we use the opportunities created by the market makers in the market. Please don't do the mistake of that. Never create opportunity. You understand? Just wait for the market makers' opportunity. So when they are moving, you make alongside them. Never go against the market makers. That's why this concept is actually going to work very well for you. I can assure you. So now, probably this concept I actually like this kind of concept that you don't need to take use up to like 30 minutes in the market. You understand? At least 30 minutes you are done. So that's why you don't really used to don't have to waste pips in this kind of strategies. You understand? You have to risk all your lot size. You understand? Because actually going to work, but it will be a small movement of pip. You understand? So that's it. Stop wasting pips, guys. Just stop wasting pips. Risk guy your lot size. Those 0.1 that you're seeing, you're risking, just like we never get you anywhere. Someone of $3, which is my student, have actually carried from $3 to 4,000 before. And I was shocked because I personally have never done this before. I gave him the signal. I personally took $25 from the signal. And you know what actually happened? This guy actually earned like 4K dollars on that particular signal with small pips for higher loss size. He was scapping, then before you know it, so they just that's what I can actually like just save you. You understand? Know the strategies you're actually working with. Don't go against it. So that was too much about time. Talking about the validation, I've talked about the validation of the downtrend and uptrend. So for uptrend now, this will be okay. This will be the lower, the higher low. You understand? Higher low. Okay, let me write it down so that you guys don't actually make a mistake about that. So validation of an uptrend will now be it will be another higher low. It will be another higher low. Understand? Then we have what again? We have higher high. We have another higher high here. Sorry. another higher high. So now, can you see the difference? These are the validation of uptrend and downtrend. You understand? So now, let's start about that, about the validation to know maybe there wants to be a reversal, or you understand? I'm still talking about the price delivery now. So now, we said this was what? Okay, let me put this thing first. What actually happens is accumulation first. That is, the market will what? The consolidation, then followed by manipulation. Manipulation will be like it will tend to do a false breakout, then distribution. You understand? Then retracement. Then what? Reversal. Know these things. No. So without even looking at all this place now, see, accumulation, manipulation. See the accumulation here, the manipulation too is here, we switch to lower time frame. It's very, very here. Now see the distribution, reversal, reversal, reversal. This distribution has, because it's actually going a bluish, is an uptrend. So you can call this move bluish move, impulsive move, retracement, impulsive move, is a retracement, impulsive move, retracement. But now, if you look at the validation, which I was saying that the validation for uptrends and downtrends, you see that this actually is actually breaking, tending to come to this. Okay, if you see that, okay, this higher low here, there was a higher low here which we put here before. If you see that the price of the market are actually falling below it, and that was not supposed to be, you understand? That is, the higher low, the current higher low must always be higher than the previous higher low. But in this case, the current higher low broke down below it. So definitely, it's trying to tell us that there has to be a change in what? A change in direction of the market, that is, the reversal wants to occur, not a retracement anymore. And this was because if you look at the confirmation again, we have our zone here. So definitely that's one of the reasons why it actually happened. And so I don't know if you guys know how to draw trend line, but trend line is not something that should be new to everybody. Understand? Trend line is like just picking, just drawing your line vertically to pick lines like this, 1, 2, 3. And you see that, okay, fine, it broke out, came for a retest. You guys did a retest and stuff like that. So it's not as if SMC concept is actually going against price action. They work together hand to hand, guys. They work together hand to hand. But those, I don't know, maybe the mentor that tends to like teach you guys, no, they don't go against each other. You have to use your price action so that you actually have to know what you are doing in your SMC. You understand? So now, so what next? So we've talked about the validation. So now, because the higher high, this higher high now, you understand, is not up. This higher, sorry, this point higher high should be up, but it's not up. You understand? So we can actually now draw a line like this. Okay, wow, because it's no more valid. You pick it from here to here. Then you call it SMS. You call it SMS, which is swing failure. Don't worry, I'm just trying to like privacy everything now like this, because don't worry, when we tend to continue, you actually get it more because we're using our time frame by then. Call it SMS, also known as swing failure. You understand? So I'm giving you 3 gold signals now. You can call it SMS. They also know it as swing failures. That is swing, bluish swing failure. So definitely it's coming down. And now we actually need to get to this place. Okay, okay, fine. The market is coming down, but where are the places that the market is actually going to reach before it's actually going to go up? You understand? So that's what we're actually going to look. So we are actually going to look at so many things, you understand, to put in the conversation. Now, if you go back to the book, that's when they were talking about retracements, you understand? So basically, we actually tell you guys in which on how you can actually configure your Fibonacci retracements, you understand? And what I mean by Fibonacci retracement was a tool that was actually being a mathematician, I think, or is it mathematician, but his name is Fibonacci, you understand? And he actually took this word from the arithmetic progression and geometrical progression of numbers, you understand? So now, coming back to trading stuff, You understand? Okay, these are three numbers. We have the three golden ratio, three golden number in Fibonacci, which is the 31.8, 61.8, and 31, 60, and 50. The 50, we call 50 equilibrium. You can actually use the Fibonacci to for any or for many things. You can actually use it for a discounted price if you want to join a market. For instance, maybe they gave a signal, buy so, and you got to get the signal late. You can't actually enter bam immediately, so you have to make the market to retrace. And for you to know the particular place the market will retrace to before you actually get to buy, that's what we call a discounted price, like buying at a discounted price. You actually have to use your Fibonacci retracement to understand. For using SMC, I'll just tell you, we'll only be considering 50% and 79%. Okay, let me just say 50, 70, and 79. Those are the ones we're actually going to be using. For synthetic traders, you can actually use the 38, use the 61, use the 50. Okay, 50 doesn't really work in 30, use the 31, use the 61, it works, and sometimes 70. So now that will be that about that when we actually continue with this class. So now, Fibonacci retracement. Okay, retracement. No, I said there are so many things you're actually going to consider, even though you want to use the Fibo. Okay, fine. Let me draw this Fibo. I want to look at where this market is actually. You know, I already said that there was a buy side liquidity, a manipulation. You know that the market wants to go up, but the market cannot just go up. Wow, that has to come down to a certain point before it starts going up again. That's what for preliminary support. You understand? So now, when you actually want to draw a Fibonacci, you actually have to use your high and low. Your high and low, your initial high and your initial low. Or let me see your current high and your current low. Now, these are our low. Where's our high? This is our current high. Now you can see the market very well. This is the 0. This is the 0. This is 28%. This is the 38% I was saying that is actually part. You understand? And this is the 50%. You understand? This is the 1%. This is 70%. You understand, guys? So now looking at this thing now, I can actually just tend to say, okay. And if you look at this, this will be 79. This particular place will be 79. Let me draw the line. This should be 79. This should be 79. This should be 79. Now, I said here, this should be 79. So now, guys, what do you think is actually going to happen? I'll actually go for 79. Do you know why? Because now, when we are now here actually. But when it comes to SMC, there are so many things you actually have to look. You understand? When expansion happens, you understand, in the market, going back to price delivery, and it moves so fast. You understand? There's what we call imbalance in the market. You understand? And imbalance means that the market, let me see, the numbers in which the rate at which the market buy must be equal to the rate at which the market sold. You understand? So if buyers cover a certain movement for a certain movement, you understand? Maybe buyers move from A to B. You understand? To balance the market, sellers to have to move from that B to A back. You understand? To balance everything, it actually has to happen in the market. The market has to be balanced, or else the market will be unstable. You understand? It's more or less like, okay, for instance, now I have a shop. The rate in which I'm buying my goods inside must be because of the rate in which I'm selling. You understand? Even though it's not like, if I'm buying it, I have to sell it. I don't know if you understand what I'm saying. If I'm buying it to resell, I'm buying to resell, exactly. So, you understand? So that's called balancing already. So the price is buying, it has to come back and sell. You understand? So there are some actually aspects you actually have to know where the market's actually going to sell, because it's not actually possible for you to be selling a carton of biscuit and be selling, going out of stock. Is like, so at least there'll be these little pieces that will still be in the shop. Understand? So the same thing applies to this place. You understand? But also know the particular place in which the market is now going to sell to. Understand? That's where we're actually going to look at some things. They call them points of interest. Point of interest of the market. Understand? Or where the price of the market is actually going to be. And I personally have two things I actually look at when I'm talking about the point of interest. And that's the fair value gap, liquidity void, or you can call it imbalance, understand, and the other blocks. And we have some other blocks. We have the bearish and bullish. Understand? So fine. What is an imbalance? Or let me say what is fair value gap, FVG. If you ever look at FVG, is this with actually three candlesticks, you understand? Okay. I don't okay, let me use another place. I don't want to clean the Fibonacci retracement. For instance, now guys, now look at this. After a consolidation, understand, and stuff like that happen. Okay, look at this now. Very good. Very, very, very good. Now, considering another block is, for instance, I said we have bearish and bullish. So now, a bearish order block, which is this, is actually a bearish candlesticks that is before. So that happens before an expansion occur. That is distribution occur in price delivery. So for instance, now see, this was the last bearish candlestick before the market started pulling. Same thing applicable to Bitcoin. If you guys are actually dealing with Bitcoin, so you actually know where the market will actually sometimes from key levels. You understand? This is more or less like the market was actually at this initial push, and so many people invested in it to actually buy. You understand? The rates will actually go up. You understand? So definitely, and when these people take away their money, that they are not doing again, the market has to fall back inside to where it was before. That's just the basic things of order block. That's how the bank levels work. When they buy here and they take their money, the market has to fall back. So that's it. So now, when you actually want to trade with other block, let me just continue. So now, when there's another block here, definitely it means okay, the market is coming to come and mitigate this other block, coming back to this other block. So now, if you actually want to trade with the other block now, if you want to trade with other blocks, there are things you actually have to consider too as well. Now, you take the high and low of the other block. Understand? Most times, I always advise people to use. You can actually switch to lower time frame very well to know the exact other block code. Because inside this other block now, there's a lot of other blocks there. So just to be precise, or just to be accurate. So now, but let's consider maybe this is a lower time frame now. So now you actually have to use the head here as your entry. You understand? That is believing that the eye, or sometimes people use real body, but let's use the eye. But most times, you understand? That is when the market is actually coming back. You know what used to happen? Once you touch the eye, it goes up again. You understand? When it comes to mitigate the other block, it goes up again. You understand? So that's basically what happened here. So now if you actually want to put your stop loss, if you use that as your entry, always put your stop loss below the other block. Now, if you look at this very well, you see that this particular place didn't go below, it didn't fall out of the other block. You see, it was still working around the other block. So that's a signal for you guys. Anywhere you see another block, anywhere. You look at this for an example now. Can you see why I said it's good to use the tip? This is another block too here. Now, scanning the high and low. Can you see when the market actually? But I'll just tell you, if you're actually looking for other blocks, always mix of other blocks in your zones. Don't just pick other blocks anywhere. Yeah. Don't pick other blocks anywhere. Can you see? Then it came down. So like I was saying, these are small movements. Don't waste pips. Put a lot size. Yeah, you are talking about money here. So now, after that, what next? Okay, we've talked about okay. So what? Let me talk about the fair value gap too before we now go back there. Now, talking about fair value gap has to do with three candlesticks. That is, when you see something like this, these three white figures, there is imbalance in the market. But just to explain things further, so now dealing with three candlesticks, it means that okay, fine. Which else can I use? Okay, making use of. Let's go back outside this place. Sometimes news can cause wahala, so be careful. This is news, so that's why sometimes it's not good to trade around for that's news. So. But at the same time, you now switch to that time frame, you now see that it's other block, everything like this, they are all together. At least you come out of it. So now, but without wasting much of our time, let me explain. Now, I said it's a three candlesticks, you understand? Now let's use one, this one, two, three. You understand? This is it. The ever look out for bluish candlesticks. You take the first candlestick, you use the close, or use the eye. Let me use the eye for the first candlestick. Then go to the third candlestick. Yeah, isn't three, oh, and use the low. As long as the low of the third candlestick did not have not hit, as long as the low of the candlesticks have not hit the low, the high of the third candlestick is called FVG. Can just be looking at for three candlesticks, just be FVG. Don't me, I start from the middle. So you always start from the down immediately after the expansion of course. You understand? It is FVG. You understand? Now let me start again from here. Same thing applicable to here. Let me use this candlestick. Same thing applicable to here. This one follow candlestick. Using this one, two, three. You know, this is the low. FVG here again. FVG here again. You understand? So can you see it was what the market came to meet with other block too. So now can I say okay, because of that, we take the other block and where the FVG began, now screw them like this and call them our point of interest. I don't know if you understand. Don't worry. It's not time for fair value gaps and everything yet. I'm just trying to explain in small this thing now so that you actually get it. This class is supposed to say for 5 minutes. So same time people say when we come back here, you see a lot of imbalance, which is behavior value gap, FVG. See here. Though the market was actually coming back to me very soon. But still see now, there's still a lot of this thing here. And my people see, this is another block here. See another block here. And now see the value gap. This from this place now. From this candlestick. This is the high of the candlestick. And this is the low of the third candle. I even like this one to explain to you. I said it's three candles. It does not necessarily mean that it's weak. It has to be bluish, everything has to be bluish. Same thing applicable to bearish. You understand? Because see now, this is the for bearish to be the low. You understand? And the high. So you can see that the market came back to its the low of the candlestick. So same thing applicable here. The market has not actually come to this to feel this FVG here. So definitely the market has come to this place. And now the fact that there's another block close to it too. So definitely the market is coming back to 16. I'm using 1873 before it starts to buy. You understand? That doesn't mean we have to wait till then. Because if you actually now look for lower time frame, you now see something similar to all these things. Lower time frame that actually will be making small. You understand? But for some traders that they are long time traders, they have actually placed their sell here. Even though it's increasing, they don't care, but they know that the market is still coming to this particular side. But we are the scalper, we go everywhere. You know the market makers. You don't have to be scalping and make use of good opportunities. As simple as that. So now, going back to okay, I was saying, okay, now can you see the FEG? So making use of this as the first candlestick, second candlestick, and third candlestick. Can you see now? That is, there's a very value gap from this place to this place. So definitely the market is still going to come to balance around this one. So definitely now judging with the Fibonacci retracement, okay, definitely now which number am I going to? Which number of the Fibonacci is how will I say it? Is which number of Fibonacci number is as the highest probabilities guys we're actually going to serve as a reversal. You understand? I will not say it's 79 because around that 79 we have the fair value gap. You understand? We have the other block. We have an other block, a very other block there. You understand? So fine, that's where good is coming to. So now we can say we want to go for a sell. Yes, right? So that's that about the Fibonacci retracement. So what else? We talked about Fibonacci retracement. Okay, so now let me talk about the BMS. Because I know you guys used to see BMS very well. BMS means the break in market structure. BMS occurs when the price closes above or below a swing, high or low. You understand? That is when the market breaks above or below the higher high or the what or the I will use the previous example we used to explain now. The higher high of it breaks the higher high for uptrend and it breaks the lower low for downtrend. You understand? And I was talking about OTA too. Like I was saying the other time that you can actually use your Fibo for so many things to buy at discounted price and stuff like that. I will explain that too. So now let's talk about the BMS. We talked about the swing failure. This is the SMS. So now let's explain everything back now. So we know that the next class we are starting it in proper. All right, so we are starting in proper. This is just a Pharisee of everything. So now I want to talk about we talk about swing failure or failure swing. I want to talk about the OTE. I want to talk about about the BMS. What I was saying now is, I was saying the validation. Now let's go back to the downtrend. I said the validation for a lower high, for a downtrend is that the lower high must always be. So this was a mistake, I think. When I was copying and pasting, I don't know that it was already copying and pasting. Okay. So as I was saying, now I was saying the validation for a downtrend is that the current lower high must be lower than the initial lower high. You understand? This is lower than this. This is higher than this. You understand? So now definitely. So now that the price of the market broke. That the price of the market broke below this lower low. You understand? It's called a BMS, break in the market structure. It's more or less as still giving a validation that okay, it's still what? It's still in a downtrend. It's just for an easy use. I was saying that it has to go below it. So it's a line that probably it will make you know and to be sure that okay, it has actually gone below it. All these things just make the trading to be easy. It's something that can actually use your face to pick. Don't mind my line. And when the market tends not to break it and it's forming something like the equal low, then you know that the price of the market wants to. So another thing, you understand? For you to even know the higher chances of where manipulation wants to happen, you understand? In the markets, you understand? You look for the ones that has the highest number of equal high or equal low. For instance, now see this one has the highest number of equal lows 1, 2, 3, 4.
definitely everybody will believe that that is a very strong zone because that actually happened 4 times. But no, the market makers have seen this. And that's why they want the migration to happen because the migration to happen here. You guys be like, okay, this thing is strong before. So definitely for you to break it down, it means it's more strong. You see strong, it's still very, very, very strong. They're standing. The market makers that want to shake you, not the zone. And they are just as simple as that. You just have to be patient. Understand? Ever since I've actually learned this strategy, I've always been of like have the peace of mind because you don't need to like create opportunities yourself. You just have to wait. Even if you take 2 days, you wait. And you'll be sure that you find out 2 days you're actually going to make them. And most times, it's not because I don't always tend to like give you guys signals and think that okay, that maybe some people might actually not take 1 or 2 of the signals, thinking, okay, let me make it 3 for others, some other people. And because of that, sometimes I now tend to like over trade. Though personally, I take my accounts just once they trade and that as well. And trying to give you guys signals. But I don't even like it because I just like just analyze the markets. Analyze that like I actually want people that probably maybe actually they can't this so time I'm giving you the signals and actually get to work out this so time. As simple as that. I want to end the class before 2. Right. So definitely anyone we didn't really talk about it, we'll talk about it in the next class. So now we've talked about the validations, we've talked about this thing. So now you can call this your BMS, that is your break in market structure. Um, you can now call it VMS. VMS. Same thing applicable to all these ones too. You understand? This was the lower low, lower high. We broke it above, you can call it VMS, you understand? But immediately you see that it didn't break it above here. But instead, this lower low here is break it below. You understand? It's no more BMS. So you understand? Because that will be the first thing that actually happened. So you cannot call it BMS. It's actually breaking market structure, but just for you to understand what actually happened there, you call it change of character. You understand? That was the first thing that actually happened. For instance, now, as soon as we switch to a lower time frame, it was supposed to be a lower high. You understand? But instead of it coming out to break this one actually was higher than this. You understand? So you can actually call something that happened around it, but it's not that specific. So I don't want us to use it, not to confuse you guys. You understand? I want to do some specific. So for instance, now, see this. This is a downtrend. So this is a lower high, lower high, lower high, lower high. So expect okay, this is another lower high. Yeah, yeah, this is okay. This is a lower high too, right, guys? This is a lower high, this is a lower high. But instead of another lower high from me here, around this point, I'm coming down. It broke it bearishly, it broke this high bearishly. The validation of it broke the validation of the downtrend. So what actually happened there is what we now called, we now bring it up like this, that it broke above it though. So definitely what happened there is what happened here is called change in character, which is the same as trying to tell us that okay, the direction of the uptrend is no more going, that there must be a change in direction in price. CHOCH. I know you understand the difference in the BMS now and the CHOCH. Understand? So the next thing you actually have to do is now you now take the low to the worst, to the lower low to the, you take the higher low to the another higher low, or you take the lower for that's for English, and or you take the lower low to the lower low to know that, not to show that there's a swing failure. All these things, it's not necessary to write it once you can actually cite and understand it. So that's why what I put it as swing failure SMS here around there, because instead of it breaking this, it breaks, instead of it breaking above this high, it broke below this low here. Can you see here now? So this is what happened here is CH, the change in character. Understand? And before even the change character, of course, then you see we already detected that we have our swing failure here because it's not higher than it. Understand? We have a change in character here, trying to tell us that just as simple as that. So now we're talking about OTE now. OT is more or less like entering at a discounted price, 50% discounted price, or any kind of discounted price. For instance, you are given a signal to sell around this place. Understand? But when you came back, you saw that the market is already here. You don't want to enter here, guys. You don't want to enter here, guys, because you don't know that, okay, for you to enter, you're actually entering at a premium price because the market has to retrace. It will always retrace. You understand? So now, you waiting for a particular time for it to retrace or where it retrace to is called OTE. You understand that? OTE. You understand? And the OTE will always be was the lower low. Like when it wants to form another a lower high, sorry, when it wants to form a lower high before it's continuing back. You understand? That is the tip of the retracement. So you can actually use your Fibonacci retracement to know that place too. You understand? Now let me choose now. So now this will be our high. I'm picking from our high now. So our low here. This will be our low because we want to assume that these places have never existed before. So now, if you look at this very well, we will see that the market when it came to 50%, you understand? Then I was saying that 50% would be your discounted price, you understand? It's called OTE. So most times it comes to 50%. And there's a reason for it that it came to 50% to look bigger, deeper. You look at maybe there was another block here, another block, and definitely there was another block here. Because this is another block. This one, the expansion movement. See, it was very strong candlestick. You understand? So normally you could have even entered around 0 points or 38, ratio 38. You understand? And put your stop loss above. You can just like what I explained here. You understand? Or still going to come. You just enter at a discounted price. You enter at a discounted price. So that's what we call OTE. An entry time, ultimate prime entry. You understand? So same is applicable for everything. That's why sometimes when you miss a signal, just wait for the OTE. You understand? The retracement to happen before you enter. So that's that about that, guys. So what else? Let me check the book again. So I don't think we have something to talk about the range high, range low. Oh no, those ones are not really necessary. What are the swing failure, SME? So tomorrow we'll be talking about market structure. You understand? So what are the market structure? They talk about the price can simply be found in one of the three phases below consolidation of trend. I'm talking about that one. Yeah. Don't worry. I'll actually be talking about my own. Right? It looks like I've actually talked about the market structure alongside this video. Well, no, tomorrow this thing. I'll talk about supply and demand. I've actually talked about that other block today. So you guys know about the other block, put beige and blues. Know about it, put it, watch this video very well. So talking about supply and demand tomorrow, the laws guiding it. You understand? Talking about why cost schematics, how to draw trend line, chart patterns, all those ones we'll be talking about. Then tomorrow, so next tomorrow we're talking about liquidity. Understand? And liquidity forex market is a sum game. Is a sum game, which means that for a trader or institution to buy, sell one currency pair, it's necessary that there's another trader institution which with an opposite position. If the banks wants to buy a currency pair, then we need a seller in the market. The existing facility to place this position in the market is called liquidity. You understand? So now can I say liquidity is defined by stop losses? Where the stop losses exist is where the liquidity also exists. You understand? That is where you want to put your stop loss. Where you are thinking, okay, your stop loss to be where the liquidity also exists. So that's why I say like, the market has we always hunt your what? Your stop losses. You understand? It's also called stop hunts. You understand? But don't worry, at the end of this class, that's if you actually in the trading in our boot camp. Let me just say, if you're actually in the boot camp. So you'll be able to like at the end of this class, you can actually just don't worry. I'm giving you my or like I'm touching my chest that by the end of this class, if you don't come with a testimony, then I don't think this is for you because I'm very sure everybody will come with testimony. So that's all about that, guys. Thank you very much. God bless you. Till tomorrow, guys. by 5 p.m. But Mr. Lanka said 5 p.m. Should we start to review by 5 p.m.? So no problem from 5 p.m. to tomorrow. Well done, guys.